Warren Buffett has famously supported investing in the S&P index for passive investors, but today on Business Mob, we will be revealing why the Wall Street connoisseur is holding back from investing and taking a more reserved approach by holding cash. He commands respect on Wall Street. Some investors even refer to him as the godfather of Wall Street. There is a method to his investment madness, which is why everyone looks to his actions for guidance. Warren Buffett famously advocated for passive investors to invest in the S&P 500 index. The Godfather even stated that betting against the index is betting against America. Sure enough, the economy isn't looking good, with warning bells ringing in almost every important sector right now. Warren Buffett is holding large sums of money on reserve, and he's not even investing in the trusted S&P 500 index. The long-time investor may be betting against America. Buffett has been known to capitalize on market declines. As long as there are bull markets, there will be bear markets as well. The seasoned investor is flexible between both and knows how to use both to his advantage. It's now become his strategy to hold cash for long periods of time to quickly capitalize on falling stock prices. No one can truly predict when the stock market will fall based on current market conditions. Investors know the market crash may take a few days or even months, but Warren Buffett has determined that the market will fall regardless, and he's not taking any chances. So after many stock valuations, he thinks they are now at prices that are becoming too difficult to justify. Tesla stock is currently valued significantly higher than its intrinsic value, and its market price is unjustifiable. Cathie Woods has been seen offloading prime Tesla stock, much to everyone's surprise. Investors such as Bill Gates completely liquidated their positions in stocks that they had held for some time. These billionaires are either insane or smell a rat in the room, and from the looks of it, is probably the rat option. Warren Buffett's long-standing philosophy has been to identify fundamental value in a company for the long term, giving him a competitive advantage. He applies this strategy even during bear markets. Buffett's strategy in bear markets is usually to make some large investments in blue-chip stocks when their stock price is undervalued, which means that stocks that would have otherwise been highly priced are being sold at a discount. Buffett has developed an investment model that has benefited Berkshire Hathaway shareholders for some time now. He prioritizes long-term gains over short-term gains. Cash reserves provide the investor with the option of choice, whereas your money would otherwise be held hostage in financial markets. Warren Buffett believes he needs over $140 billion in cash reserves to sleep at night. The price he pays for the cash reserves is the opportunity cost of missed returns, which is attracting criticism. Buffett warned against investing in highly leveraged companies or businesses in weak competitive positions because when a recession hits, those are the companies that are the first to be buried, and they become options in such an environment, making them risky investments. While leverage presents an opportunity for growth in a bull market, debt becomes more expensive in a bear market, and it may cause a liquidity crunch in a company. Warren Buffett is choosing the conservative approach in the hope of earning high returns in the future. The man is consistent and follows a pattern, which has led him to the reserves that he currently holds. Buffett once said that bad news is an investor's best friend because it allows you to buy a piece of America's future at a discount. What investors require instead is the ability to ignore mob fears or enthusiasms while focusing on a few simple fundamentals. A willingness to appear unimaginative for an extended period of time, or even to appear foolish, is also required. Judge him all you want for holding that much cash, but he definitely doesn't mind looking foolish now that he's trying to avoid all the mistakes most investors make during a market crash. Buffett is basically admitting that the crash will occur as he has doubled his reserves since the 2008 crash. This clearly shows that this crash will be at least twice as bad as the 2008 crash. If you weren't taking the market crash seriously before, this should change your mind. Warren Buffett has received attention for holding such large amounts of money on reserve when he could have profited from it on Wall Street. Instead of capitalizing on this, the investment guru withdrew money from the market and kept it on reserve in cash. One thing is certain: Warren Buffett is decisive and has brushed off the naysayers. After all, he is the captain at the helm of the ship and doesn't listen to the backseat drivers. It is too early to call the journey a success. While predicting the next crash may be impossible, planning for it and being prepared to capitalize on it by retaining cash may be a fruitful strategy for all value investors.